Hello, and this is Dr. Seitz, and today we're going to talk about a demonstration problem of taking some transactions from years 1, 2, and 3 for a computer services company and taking those transactions and then trying to figure out how they fall into place as those financial statements. So basically, we're going to take these problems that we have here, for the accounting cycle. And I'm going to start with the transactions from years 1, 2, and 3. And I'm going to pop over into Word and then write in what the answers would be. So you should have these demonstration problems available to you. So you might want to go ahead and have that as I'm going through the video. That way I won't have to be popping back and forth between screens very often, and I can just stay on my work paper screen. So transaction for year 1, the computer service company was started when it acquired $9,000 in cash by issuing common stock. So I'm going to be reading these transactions, and then I'm going to pop over here to my Word document, and I'm going to write those transactions in as we're trying to figure out how those transactions fit into the financial statements. And so the computer company was started when it acquired $9,000 in cash. And so I need to think about what accounts would be affected. And I know obviously that cash would be increased. So I'm going to go ahead and write 9,000 in here as cash is increased, because I know that those assets of cash has increased because the company itself received in the cash in order to be started. But what that also means is that it issued common stock. And so common stock is under here under stockholders' equity. And what that does is it gives owners in the business their section of, or their little slice of the pie of the business. So in order for this to work, my accounting equation has to balance. And so we know that assets equal liabilities plus stockholders' equity. And so if I look now, I show that 9,000 plus 0 equals 0 plus 9,000. Plus 0. And so yes, then my accounting equation does balance. So these totals are what they should total up to. If you were doing this in Excel, I would require you to put a formula in order to formulate each column. But for the purposes of this, I'm just going to write them in. The second one for year 1, the company borrowed $5,000 from a bank. Well, what happens whenever you borrow money from the bank? They give you cash, but you also have to give them something in return. And you're giving them is something like a promise to pay or a liability. So again, with assets equal liabilities plus stockholders' equity, I received $5,000 in cash. And then I also increased my liabilities by $5,000. And my accounting equation once again balances. The company provided services to customers and received $4,000. So I'm going to go ahead and write that I received $4,000 in cash. Well, what did I give them? I gave them services, and that's what I'm supposed to be doing. And so retained earnings, if you listen to the prior video, the statement of retained earnings starts with the beginning retained earnings. We add in net income, and we subtract out dividends to come with ending retained earnings. We also drilled down and said that net income is revenues less expenses. So inside this retained earnings, we have revenues less expenses, and to be completely correct, it would be also less dividends. So we received $4,000 in cash. So what that would actually do is increase our retained earnings, because an increase in revenues increases net income, which increases retained earnings. So that would be a revenue over here, revenue increase. 4, the company paid operating expenses of $2,900. So I'm going to put this in parentheses to show that it's a negative, it's a cash outflow. So just like retained earnings was increased with a revenue, it would also be decreased with an expense. And finally, for year 1, the company paid $500 in dividends to its stockholders. So again, I'm going to decrease the $500, and like I put up here, dividends also decreases retained earnings. Dividends are never an expense. Dividends are never an expense of the business. They're just a return to the stockholders. So if you would add up all of your assets here with your cash, you would add that up, you would get $14,600. We didn't have anything in land. Liabilities, we only had one transaction that happened in liabilities, so that's how we ended up with the $5,000. One transaction in common stock ended up at $9,000, and we had a lot going on over here in retained earnings. So beginning revenue, revenue less expenses and dividends, we would come up with an ending retained earnings as of the first year of 600. So our beginning retained earnings is 0. Our beginning retained earnings is 0. Our ending retained earnings is $600. Let's move on to year 2. So in year 2, we have the company issued additional common stock for $4,500. So just like we talked about at the very beginning, if I get this off the screen now, we would increase our cash because we received $4,500, so we need to increase our cash. The other thing that I want to point out here is that the balances from the prior year have now rolled down. So if you can see this, the totals from year 1 are now the beginning balances for year 2. Okay, for all accounts. This has just happened to be 0, but for all accounts, those ending balances for year 1 are the beginning balances for year 2. Okay, so I increased my cash as well as increasing common stock. Transaction 2, the company paid $2,000 to reduce those liabilities. So cash outflow, I'm going to decrease my cash, but I'm also going to decrease my liabilities. So if you look at it from a horizontal calculation, every time I do a transaction, my accounting equation still balances. Year 3, the company provided services to customers and received $6,700. So they received $6,700 in cash. And as our discussion above, $6,700 is a revenue, so it increases the stockholders' equity, specifically the retained earnings. The company paid operating expenses, so I'm going to decrease my operating expenses and decrease my retained earnings because expenses always decrease retained earnings, and then of course they paid dividends. So it's pretty much the same as the prior year, but you can just see how the math continues to play out. All right, so if you again do the math, beginning balance of 14,600 plus 45 less 2,000 plus 6,700 less 4,300 less 700, you're going to come up with a balance of 18,800. Do the math all the way across, you're going to come up with all these balances that we see here. Now we're going to move on to year 3. Notice, same thing happened. That's why these are called permanent accounts. These accounts never close. They never go to 0, close out to 0 like our income statement accounts will whenever we get to that discussion. So here we are now in year 3. Year 3 transactions, they issued additional common stock. So I'm going to increase my cash by $2,500 and increase my common stock. Accounting equation still balances. They borrowed $1,000 from creditors, so I'm going to increase my $1,000 from the creditors, but I'm also now, I had $5,000 in liabilities, I paid $2,000 down, that leaves my balance of $3,000. Well, I borrowed more money, so I'm going to need to add more to my liabilities. 3, they provided services to customers and they received $7,400. So I'm going to increase my cash by $7,400 and increase over here my revenues by $7,400. Operating expenses were paid of $7,900, so it decreases my cash, also decreases my retained earnings. They paid dividends of $300, so I'm going to decrease $300 in cash for dividends, and dividends decrease ending retained earnings and stockholders' equity. So I'm going to point that here, but we have a new transaction. They paid $21,000 in cash for the land. So I'm going to decrease my asset of cash, and I'm going to increase my asset of land. So that is a decrease and increase on the same side of an accounting equation, which is fine because it all washes out and equals 0 anyhow. So it equals 0 whenever you do the horizontal calculation. Doing the addition and subtraction down, 18,800 plus 2,500 plus 1,000 plus 7,400, subtract out 7,900, subtract out 300, subtract out 21,000, you're going to have an ending cash balance of 5,000. So if you remember, we talked about in a prior video, how did a company get from a cash balance of 18,800 down to a cash balance of 500? Well, we can see that now. We can see how the cash has came and went, and the majority of that has to do with a land purchase, not that they just lost that amount of cash, spending it on unnecessary expenses. Additionally, now we show, I didn't put enough zeros on here, did I? We show our land balance is 21,000. That's not right here. Land balance of 21,000, which is 21,000 here. We show that our liabilities have increased to 4,000, and then our stockholders' equity has now increased to 16,000, and our retained earnings with a beginning balance of 2,300 plus 7,400 less 79 less 300 equals an ending retained balance for year 3 of 1,500. The next part of the problem asks us to prepare financial statements for years 1, 2, and 3, income statements, statement of stockholders' equity, and then cash flow statements. So I'm going to move on to preparing the financial statements. And so if you have all that information written down, you want to keep it, because I will try to go back and forth, but I don't want to make you sick here trying to figure out how to go back and forth. So I take all that information that I have prepared up there, and now I take it directly to the balance sheet. So my cash as of December 31st for year 1, my cash as of December 31st for year 1 was this. Let me change it to a different color, yellow. Was maybe 14,600. Okay, 14,600. So all these balances that I have here, I'm going to take to the financial statements. And again, this is just for year 1. We also have year 2 and year 3. So when I pull these numbers, this is where I'm pulling them for. I'm pulling them from these totals from the specific years. Okay. Back to black. All right. So my cash balance for year 1, 14,600. Okay. Land, there was no land, so that leaves my total assets of 14,600. My liabilities as of the end of the year was 5,000. Stockholders' equity is broken down. There shouldn't be anything there. That's just a blank spot. Common stock would be 9,600 for the retained earnings. So the total stockholders' equity is 9,600. Okay, if you add that to the liabilities of 5,000, that's where you're going to get your 14,600. These should always match, because assets equal liabilities plus stockholders' equity. Those numbers on your balance sheet should always match. Okay, so there's my very first balance sheet. Now, before I can get on to year 2, the thing that I would need to do is prepare my income statement. So I can go down here and prepare the income statement for year 1. I did a quick calculation whenever I was discussing that information up in the analysis for the first part of the problem. Income statement for year 1, the revenues were $4,000. And then operating expenses of $2,900 leaves me a net income of $1,100. So I'm going to take that information now, and I'm going to put it down here in the beginning retained earnings, which is 0. I'm going to add my net income or loss, which is the the 1,100, literally just came right down here, less those dividends that I paid out of 500, and that's where my ending retained earnings number of 600 comes from. And if you follow that, there's the ending retained earnings number right here, ending retained earnings 600. That ending retained earnings 600 is also shown up on the statement of stockholders' equity. Okay. Now notice what happens here. My total stockholders' equity year 1 ending balance is now my stockholders' equity year 2 beginning balance. So before I do that, I need to prepare my income statement for year 2. So service revenues for year 2, 6,700 less 4,300. That leaves my net income of 2,400. I need that number to come down right here. Okay. Net income loss or loss. There's only one. It's net income or net loss. We had a 2,400. Dividends for year 2 were 700. That leaves my ending retained earnings $2,300. Okay, sorry for the delay here. I wanted to point out that this is the, I put the wrong arrow here. Let me erase that. That doesn't necessarily go there. Okay, your ending retained earnings is your beginning retained earnings. That's right there. So I apologize for that. And then that number goes right here. I haven't discussed the stockholders' equity or the common stock issued and ending common stock. So I'll do that after I'm done here. All right. So this 600 ends up being this 600. We also have the ending retained earnings for year 2 is the beginning retained earnings for year 3. Okay. And all those will show up on the balance sheet as well. Okay. So now that I have that information prepared, I have the beginning retained earnings of 600, which is the end of the year's last year, plus my net income, which I calculated from up here in the income statement, less my dividends. I now have year 2 ending balance sheet information. So I'm going to go up here and prepare my balance sheet for year 2. So if you still look at your information, your cash from year 2, your cash balance from beginning of year 2 is 18,800. Okay. I'm sorry, the end of the year is 18,800. So I'm going to take this and I'm going to, that's 14,600, 18,800. Okay. Oh, on the wrong line item. Okay, those are arrows. And then, actually, you know what? I can erase that. Cash is 14,600, 18,800. There's no land for those years, so that's how our balances got to be 18,800. My liabilities at the end of year 2 were 3,000 because I paid some down. My common stock, I'll calculate that because I didn't do that for year 1. So we added 9,000 common stock in year 1. So that left my balance at 9,000 at the end of the year. This is the number that carries forward. So I have a beginning balance of 9,000. I issued $4,500 more in year 2. So my total common stock balance at the end of year 2 was 13,500, which is the beginning balance of year 3. So my common stock balance was calculated down there. So common stock for the end of year 2 is 13,500. And like I said before, this item is blank because this is the header for these sub-accounts of common stock and retained earnings. We calculated the end of the year 2 retained earnings, and we calculated a balance of 2,300. So let's go down here. There's that 2,300. Where did we find that number? It's right here. It's where I already have it highlighted, 2,300, which becomes the year 3's beginning balance. And therefore, total stockholders' equity, 13,500 plus 2,300 is 15,800. You add that to the 3,000, and you're going to get a balance of 18,800, which is good because it equals, again, the assets equal the liabilities plus stockholders' equity of 18,800. So now I can move on with year 3. My net income for year 3 is revenues of 7,400 less expenses of 7,900, and I have a net loss this year. See, it's in parentheses, which means a net loss of 500. Well, when I dropped that down, I had a beginning balance for my retained earnings of 2,300. I lost 500. I somehow paid dividends of 300, and so therefore my ending retained earnings balance was 1,500. That number will also go up to the retained earnings ending balance right there whenever we are calculating. Let's go ahead and do the common stock while we're here. We had a beginning balance of 13,500. We added or issued $2,500 more. So now we have an ending common stock balance of 1,600. All right. Finishing up our last balance sheet, I see that the cash balance at the end of the year 3 was only $500. But now I have land of 21,000, and therefore now my total assets equal 21,500. I issued more liabilities, so now I have $4,000 that I owe. The common stock that I just calculated below was 16,000, And additionally, that retained earnings balance that I calculated below was $1,500. That leaves total stockholders' equity of $17,500. I add that to the $4,000 that I have up here in the liabilities, and I'm going to get a total liabilities of stockholders' equity of $21,500, which is great because it equals the assets, which is my whole purpose. That's what I want to do. All right, so we've calculated the income statements and the statements of retained earnings, or statements and changes of stockholders' equity, and then additionally we calculated the balance sheets. Okay, so we had to do them in that order. All right, the next thing we're going to do is talk about this cash flow. So year one, the cash flow transactions were as follows. So they acquired $9,000 by issuing common stock. So that's the $9,000 that we see here. And that is a common stock is a financing activity. Okay, so I assume that you've read through your textbook to know what a financing activity is, but basically a financing activity is most things that do change the stockholders' equity section of the balance sheet. Number two, stockholders' equity and long-term liabilities. Number two, the company borrowed $5,000, so that's an increase in cash of $5,000. Long-term liability, that's also a financing activity. Three, the company provided services of $4,000 and they received $4,000 in cash. Well, this is what they're supposed to be good at, right? This is what they're doing. So they have operating activities of $4,000. Operating activities are their everyday business activities, what they're supposed to be good at, what they're doing. The company paid operating expenses of $29,000. Again, what they're supposed to be doing. And they paid dividends. So dividends is a decrease in cash, but it's also a financing activity because it's reported in the statement of retained earnings, which rolls up into the stockholders' equity section of the balance sheet. Year two, moving on, the same things. $4,500 common stock activities or financing activities. $2,000 to reduce liabilities. That's a decrease in cash though, but that's still a financing activity because it's a long-term liability asset classification, long-term liability classification on the balance sheet. Therefore, it's a financing activity. Number three, provided services. This is what I'm supposed to be good at. This is what I do. So it's operating activities. Remember, we have operating, investing, and financing. Those are my only options. Okay. And number four, you paid operating expenses. So I'm going to decrease my cash by $4,300. Again, it's operating because that's what I'm doing in order to run my business. And then $7,000 paid out in dividends. Dividends again are financing. Year three, additional common stock. Let me go again, increase cash by $2,500 for financing. They borrowed $1,000. That increased my cash, but it also increased my financing. They provided services. We received cash. This is what we're supposed to be doing. So that's operating. They paid expenses. So I'm going to decrease my cash. Operating. They paid $3,000 in dividends. Financing. And then here's the new one. We purchased land of $21,000. Land is a long-term asset. And so long-term assets are investing. So you'll see me put investing activities. So taking all that information now, I can go through and set up my cash flows from operating, investing, and financing for 3 years. All right, so I'm going to start off with cash flow from operating activities starting the first year. And cash inflow from revenue was $4,000. Cash outflow for operating expenses over the year was $2,900. Year two is $4,300, and year three is $7,900. Now, in practice, you wouldn't be able to do 1, 2, and 3 years at the same time because usually you do this 1 year at a time. So net cash from operating would be $1,100, $2,400, and $500. Looks a lot like net income, doesn't it? Investing activities. So here is operating, investing, and financing. Okay. Investing activities is the outflow for land. Well, I only did that one time, and that was in year 3. Okay. And financing activities. So in the very first year, inflows from borrowing, I borrowed $5,000, and then I also borrowed $1,000 in the third year. In the second year, I paid down that debt, so I'm going to show this $2,000 outflow. And then inflows from cash issuance, I did that every year. So the first year I received $9,000. The second year I received $4,500. The third year I received $2,500. And then net cash flows from financing activities, or I'm sorry, outflows for dividends. I didn't do that. Every year I paid dividends, so that's cash out. That's the particular year. All right, net cash flows from financing activities. So 5,000 plus 9,000 less 500 is 13,500. Okay, 2,000 plus 4,500 less 7,000. And again, that's a negative 2,000 is 1,800. And then year 3 has 1,000 plus 2,500 less 300. So for financing, year 3 is 3,200. All right. So now what I do here, this net cash change is a combination of 3 things. You need the operating activities. Okay. You need the operating activities number. You need the investing activities number. And then you need the financing activities number. So those 3 numbers will give you the net change in cash, which is how those are calculated. And in year 3, we had quite a bit of change in year 3, and it's mostly due to purchasing that land, right? Okay. So beginning cash balance for year 1 was 0. Beginning cash balance for year 2, and I'm getting this from the balance sheets up in a prior screen, 14,600, and then beginning cash balance at year 3, 18,800. So year 1, ending cash balance that you will find, this is on the balance sheet for that current year. So 14,000 change in cash plus 0. The balance sheet for the first year, if you scroll back up, should have an ending balance of 14,600. Then the beginning, that's where the beginning balance for year 2 comes from. Okay, beginning balance from year 2. So you add that to the change in cash flows, you're going to get an ending balance of 18,800. That will be on the balance sheet, ending cash balance for year 2. And if you notice, that's the beginning balance for year 3. We add the net change in cash, and you're going to get an ending balance of 500. And that is the number that will show up on the year 3 cash balance. So let's pay attention to here. We have ending cash balances for all 3 years. We calculated, we know what happened to the cash balances, why we received so much cash, why so much cash was paid out. Let's scroll back up here to the balance sheets. Back here to the balance sheets. And for the balance sheet cash balances, right here, balance sheet cash balances, look at those 3 numbers. Well, I'm sorry, not those. Look at these numbers. Cash balances right here were what we calculated in the cash flow statement. All right, I know that that's a lot of material in one particular lecture, but it's important to do it all together so you can see how the financial statements are interrelated. Please feel free to ask me any questions. I'd be more than happy to meet with you in my Zoom virtual office, or if you're on campus, you can stop by my office and we can go through this problem face-to-face or another problem that you think would be more appropriate to help you.